The linking of a liquefied or LNG contract to the price of coal is a long overdue step. It's certainly intriguing and may represent a major shift in the fast evolving market for the super chilled fuel. In a move believed to be the first of its kind, Royal Dutch Shell signed a long-term supply deal with Tokyo Gas this month that partly uses coal-linked indexation for the pricing. The unusual agreement can be seen as part efforts by Tokyo Gas, Japan's second largest LNG buyer, to diversify its supply sources and the price risk associated with having LNG contracts linked solely to Brent. The LNG industry was built on long-term, restrictive contracts that were linked to the price of crude oil, but the rapid growth of the industry has undercut that model. For example, the rise of US LNG suppliers means that more contracts are being based on Henry Hub prices, and deals also tended to become more flexible in length and on destination. The rise of China to become the world's second biggest LNG importer after Japan also helped boost the spot market, as Chinese buyers are often seeking additional cargoes beyond their contracted volumes in periods of high demand. While LNG was in its infancy, it made sense to underpin the development costs of billions of dollars of new export projects with oil-linked contracts that could last for more than 2 decades. This gave the project developers the certainty needed to raise large amounts of capital and also provided buyers with security of supply. Crude also made more sense than coal, given even 40 years ago the crude futures market was significantly more advanced than the thermal coal market is today. However, the deal between Tokyo Gas and Shell makes sense from the perspective that LNG and coal are effectively competing fuels in Japan. By linking the price, the Japanese company can hedge against competitors using coal-fired generation, while still having upside to market movements. Whilst this recent innovation makes sense in Japan, it may not have too much relevance in other countries in the region, with the possible exception of South Korea, where LNG also competes with coal. In China, LNG is rarely used for power generation, with most of the natural gas consumed by residential heating and by various industries. While natural gas is displacing coal in boilers used to heat buildings, there wouldn't appear to be too much synergy between the pricing of two fuels in China at the moment. By the same tack, in India, LNG is hardly used for power generation, with its primary application being industries such as chemicals and fertilizers. And thus, while Chinese Indian buyers are likely to be open to the idea of pricing LNG deals without linkages to crude, it's unlikely at this stage that they'll look to a coal index contract basis. Rather, spot pricing or short-term deals linked to existing LNG or natural gas indexes are likely to hold more appeal, as these offer sufficient flexibility but don't require strong knowledge or the workings of another market such as coal. The overall significance of the Shell-Tokyo deal isn't that coal is getting on the LNG Act, it's the LNG market is continuing to evolve at a fairly rapid pace. With new supply additions expected to exceed demand growth this year and next, it's likely that a variety of more flexible pricing arrangements will emerge. This will be underscored when the next wave of LNG projects start to come on stream in the middle of the next decade, as many of these are likely to be sanctioned without the underlying guarantee of long-term crude-linked sales agreements.